Welcome to Lesson 25. I'm Professor Matt with the Fundamental Investing Institute. In this lesson, we're discussing operating ratios. These ratios help us understand how efficiently a company manages its assets, particularly its working capital, inventory, trade receivables, and trade payables. Operating ratios show how quickly a company moves through each of these, how fast it sells inventory, collects cash, and pays suppliers. Let's start with inventory. For retailers and manufacturers, inventory ties up a huge amount of capital. Managing it well is the difference between success and failure. The first ratio is inventory turnover. Cost of goods sold divided by average inventory. A higher turnover means the company is selling and replacing inventory more frequently. From turnover, we calculate days sales in inventory, or DSI. This is the number of days in the period divided by inventory turnover. Higher turnover leads to lower DSI, meaning fewer days worth of inventory on hand and less capital tied up. Narrowing this gap is key for liquidity. Next, let's talk about trade receivables. That's money customers owe the company. Here we look at receivables turnover. This is sales on credit divided by average accounts receivables. It tells us how many times the company collects its outstanding receivables during a period. From that, we get days sales in receivables, or DSR. A lower DSR means customers are paying quickly, which is exactly what we want to see for healthy cash flow. A higher DSR means cash is tied up longer, and the company may need more outside capital to support operations. It's a red flag for efficiency. Now, just as companies sell on credit, they also buy on credit. This creates trade payables money. The company owes its suppliers. Payables turnover is inventory purchases divided by average trade payables. From this, we calculate days payables outstanding, or DPO. Companies generally want a higher DPO, meaning they take longer to pay suppliers, boosting operating cash flow, but they must balance this with maintaining good relationships. We can put these together to calculate the cash operating cycle, which measures how long it takes to convert inventory into cash, DSI plus DSR. But companies don't pay suppliers immediately, so we adjust for that. The net cash operating cycle subtracts DPO from the total, DSI plus DSR minus DPO. A longer cycle means the company must invest more in working capital. A shorter or even negative cycle is a massive advantage. Retailers and restaurants often operate with a negative cycle, meaning suppliers are effectively financing their operations. It's a very efficient model. Activity ratios also help us evaluate earnings quality, how likely reported earnings are to turn into real cash, rather than just staying on paper. Operating ratios give us a clear picture of how well a company manages its core components. If you found this lesson helpful, hit like and subscribe, and we will see you in the next lesson.